How many times have you seen the market or a stock at a key price level, knew that a good reaction was very likely, but you failed to pull the trigger due to fear of being stopped out? If you're like most traders, it'll be more than you can count. But what if there were a way to capture the trade, supercharge the reward potential, and avoid getting stopped out by fake outs that go just beyond the price zone, which is what often happens? Well, in this video, I'm going to teach you how to accomplish just that with a deceptively simple but powerful strategy. Hi, I'm Seth Froyberg, and I'm the head trader of SMB Capital's Options Trading Desk. SMB Capital is a proprietary trading firm located in Midtown Manhattan, and we provide capital for options and equity traders from all over the world, trading both remotely and in our offices here in New York City. Now, I'd like to suggest that you click on our subscribe button right now so that you don't miss any of our free trading videos that we produce for traders and investors all over the world. They're really very valuable. Okay, so this year has been a tale of two halves, with the first half being a flat out, pretty classic bear market stoked by fears of out of control inflation, which will force the Fed to tighten monetary policy. And that lasted until mid-June, when the market finally began to bounce. And in fact, by mid-August, the SPX index had actually retraced 50% from its mid-June lows as the market began to get comfortable that inflation was going to cool down and the Fed may not have to take really drastic measures to rein it in. And so some technical analysts look at a 50% retracement point as a kind of inflection point in the market, where the market could either take a breather and pull back from such a large run up in such a short period of time, or the market could keep running if it significantly clears that point. And so if you were of a mind that the market was likely to pull back, there's a pretty easy option strategy that you can employ at that point with a really solid risk reward trade-off, where even if the market doesn't initially pull back, it's literally impossible for you to actually get stopped out of the trade. Now, before we get into the details of that strategy, I wanted to mention that if you're interested in learning 3 more option strategies that our pro traders use, including the unique options trick that allows you to make money while you wait to buy stocks or ETFs at the price you want, the options income strategy that allows you to make consistent money whether the market goes up, down, or sideways, and how to make money on a stock or index trade even if you're outright wrong on direction, then click the link that should be appearing now at the top right corner of your screen. That's going to open up a free workshop registration page in a new window. So don't worry, you won't lose this video, or you can register directly for free at optionsclass.com. Believe me, you don't want to miss this. So pause this video, sign up now, and then resume watching. In order to teach you this option strategy that can turn trades that are going against you into eventual winners, we've got to make sure that you understand how call options on indexes work, because we're going to be using SPX index options in this example. Now, if you already know how they work, then just hang in there. This is going to be very quick. And so the best way to understand a call option on an index is to think of it as a bet. The call buyer pays the call seller what's known as a premium to place that bet. The bet pays off if an index closes above what's known as the strike price of the call option on the day that it expires. If the index does close above that strike price on expiration day, then the call buyer gets $100 per point that the market closes above that call strike price. So for example, if an index closes at 40.32, then the 4,000 call would be worth $3,200 on the day it expires, because the market closed 32 points above the call strike price of 4,000. But the 40.75 calls, well, those would expire worthless because the market didn't close above the 40.75 strike price. It closed 43 points below that. In that case, the call seller wins. He gets to pocket the premium he received for selling that call and collecting that premium. That's his profit. And that's all you need to know to understand this example we're going to be teaching you. Okay, so with that in mind, let's say that on that day, you were of a mind that the market is not ready to recapture all of the year's losses quite yet, and you felt like a pullback was the most likely reaction to the market hitting that 50% retracement point. So with that mindset, at that point, you could have pulled up an options chain which expired a few weeks out into the future on the day that the SPX achieved that 50% retracement, which was August 12th. And if on that day you had bought a call option at the next strike down from where the market's trading, the 4230 call option, and you went ahead and sold a call down at 4100, that combination is what options traders refer to as an in-the-money call credit spread. Now, let's take a look at the cash flow implications of this trade first to understand its dynamics. And as you can see, we sold 3 of the 4100 calls, as we mentioned, and for those, we received the price of $150.60. And remember, each point above 4,100 on expiration day is worth $100. So you multiply that price times 100, and we sold 3 of them. And so the total cash inflow from selling those 3 calls comes to $45,075. And we also simultaneously bought 3 of the 4230 calls, and we paid a price of $50.60 for those 3. And so you can see from this the similar calculation that the cost of those came to $15,240. And so subtracting that out, we can see that the net positive cash flow from this trade comes to $29,835, which immediately flows into your account. That much cash will immediately go into your account. Next, let's take a look at the risk reward trade-offs of this trade. And let's start with the worst case scenario risk. And that comes about if we're wrong and the market doesn't back off at this point. So let's say that the market closed at, say, 4,300 on the days these options expired. Well, in that case, then let's see how the options would settle. So let's start with the 4230 calls we bought, and the market would have closed 70 points above them. So we're owed $100 per point for the 3 options, which means we can actually cash those in for $21,000. But on the other hand, remember, we sold the 4,100 calls and the market closed 200 points above those. So we in turn owe $60,000 for those. And finally, we add back in the cash flow we received when we entered the trade, which results in a loss of $9,165. And in fact, at any price above 4230, that exact same outcome would have taken place, because at any price above 4230, the value of the 3 long calls we own will offset the increase in the value of the short calls at 4,100, if you think about it. And so at any price above 4230, the loss would be the same, 91.65. And in other words, the long calls put a kind of stop on the trade automatically, if you think about it. Now, let's consider the other scenario where we were right and the market sold off and closes below 4,100, let's say at 40.50 on expiration day. Well, how would that turn out? Well, this one is easier because in that case, both options, the ones we bought and the ones we sold, they both expire worthless, because call options only have value if the market closes above their strike prices, which it obviously doesn't in the case of the market closing at 40.50 on the day they expire. And so the trader gets to simply keep the 29,835 that he originally collected, and that becomes his profit on the trade. So in the worst case scenario, both options have value, but in the best case scenario, neither option has value. And so when you do the math, you realize that the reward is more than 3 times the risk on this trade. And so what's incredible about this strategy is that if you're happy with a 3-to-1 risk reward ratio, which most traders are, then you literally can't get stopped out of this trade. Even if the market pushes against your trade initially, which so often happens before the move you expect actually did play out. The difference is that with normal trades, you are forced out of the trade when that happens in many cases, and you painfully sit on the sidelines when the trade goes exactly as you expected. And instead of making a terrific profit, you're sitting there with a loss, even though you were right. Okay, so now let's move forward 12 days from trade entry to August 24th and the day these options expired. And as you can see, the market did in fact pull back with strong sell-offs on August 19th and August 22nd, and no meaningful recovery after that. And so on the day these options expired, the SPX index closed at 4140.77. And so let's take a look at the final settlement of the options that we traded and the results of that trade. So let's first start by recalling that we initially received, remember, 29,835, and then also recognizing that the index closed way below the 4230 calls that we sold. Those therefore went out worthless. However, the 4,100 calls did have value because the market closed above 4,100. And so we actually owe 12,231 on those, as you can see from the calculation, resulting in a final profit of 17,604, which is almost twice our risk on the trade. And so, what I'd like you to take away from today's video is that when you're at a key inflection point in the market where there's a distinct possibility of a pullback, the in-the-money call credit spread, where you buy calls near the index price and sell calls well below the index price, bringing in a huge credit in this process, that trade will usually have an excellent risk-reward ratio, as it did in this case. Yet you literally never have to worry about a stop. And if you're right, you'll be rewarded with some, and in really great cases, all of the huge cash haul that you brought in selling in the money call credit spreads in the first place. If you time things well, as professional traders often do, you'll end up with some, if not all of that cash as your reward for implementing a strategy with a very large upside and a very modest downside. Now, just to remind you, if you're serious about your trading, you need to check out the free intensive options class that we're currently running, where you'll learn 3 real-world option strategies that our professional options traders use all the time. Just click the link that should be appearing now at the top right corner of your screen, or you can just head on over to optionsclass.com to register for this free workshop directly. It's a rare opportunity for retail traders and investors to learn directly from Wall Street traders, but that's exactly what you'll be getting through this free online workshop. So click the link to sign up now before you miss it.